Hello, OptionStrat traders. It is Wednesday, June 7th, and I'm going to start a new series here called From Start to Finish. The premise behind this, I've gotten a lot of questions about, how do you adjust a trade in different scenarios? So this certainly is not going to be a comprehensive lesson on that because, that discussion can go on for months and months and months. But I do want to start showing some examples. So what I want to do today is I want to look at our current market. I think, as everyone knows, I mainly trade SPX, and that's mainly what I teach my students to trade for a number of reasons. One of them being, if you're in the U.S., potential tax benefit treatments. Again, not giving tax advice here. Consult your own tax professional, but there is something called the Rule 1256, if I remember right, that treats SPX, NDX, and the RUT a little differently and a little more favorably tax-wise. But the SPX is a larger product, so it's not something you should be trading unless you're comfortable with trading and you fully understand what you're doing. These are recommended paper trades, absolutely 100% for certain. But let me just kind of show you. So these are daily bars in the SPX or the S&P 500. And, we've been in a wedge pattern. Now, we did finally pop out of that wedge pattern here recently, but let's go in and look a little deeper at that. And if I want to put on a trade now, what kind of trade might I want to consider? What sort of a range am I going to play in? Now, generally speaking, for me and the type of trading that I tend to teach for income trading, I tend to go out, 30, 40 days, and that's in large part because I don't want to have to deal with these positions literally on a daily basis or an hourly basis. I don't want to day trade. I've been there, done that. So I want to have on positions that, I can go out and go on a walk, a run, a jog, a bike ride. I can be MIA for a day or two and not check in on my account and, things like that. I don't have to sweat the small stuff, so to speak. So that is why I tend to go out further in time. So the one thing I want to look at here is what type of a trade might I consider and why might I consider that trade? Well, I think the first thing that we have to look at here is, we are making in recent weeks and months, we're making higher lows, and we're also making higher highs. So we are in a bit of an uptrend now, and we have broken out of that down channel. Now, that said, if I'm going to play for 45 days out or so, what might be a reasonable range given current, the way the market has moved currently? So what I want to do is I want to come in here and kind of take a look at what our recent moves have been. And if we look at this, let's see if I can, let's see, one of these tools will give me that. This is not my normal, I think that one will do it. So if we take a look like from here to here, where we closed that day, okay, we can see, well, that was 112 points, okay? Let's look from here up to like maybe its highest point here. So we can see that, that was about 80 points, somewhere in that general range. We take a look from here up to around here. So that was, 80, 90 points, somewhere in that general vicinity. From here to here, another 80, 90 points. Then from here to here, okay, so that's 105 points. So again, part of that was we had a breakout here, and a breakout tends to carry with it a little more momentum. But we've had 1, 2, 3, 4, 5 waves now right in that 80 to 100 point range. So if I were looking to trade, what's going to be a logical range that I'm going to look at right now? Well, I'm going to look at that 80 to 100 point range. Now, another thing I'm going to look at, we've chopped sideways here for about 4 days in a row. And there's not any real big pending news on the immediate horizon. That doesn't mean that some news event might not crop up, tomorrow. But I'm largely going to look at trading between, let's say, a 4,200 range. If we got a pullback, I would expect 4,200 to be reasonable. That's about a 70, 80 point drop from where we are now. That's kind of in line with what's been happening here. Also, we're currently at 4,270. If we broke to the upside, again, we've already run over our normal run. So I would expect the upside move, again, pending any odd news, to be a little bit muted. So my objective here is to put on a trade that might benefit from somewhere around the 4,300 to maybe the 4,200 range. So let me come over here to OptionStrat and take a look. I'm in SPX, and I'm going to go to build a trade, and I'm going to look specifically at an iron condor here. Okay, that's a trade that a lot of people kind of know and understand. I am going to trade what's called the AM expiration. You know what? No, I'm not. I'm going to stick with the weeklies just because then it will trade kind of like SPY. So just let's not worry about the AM versus PM expirations right now. So I'm going to go out to July 21st, which is going to be 45 days. That's fairly typical for the type of stuff I trade. But again, I want to be able to be open to the downside to about 4,200. So I'm going to need to back off my one put down to around 4,200. Now we can also see here, look at that massive liquidity there. That's nice. I like to see that. I like to see the fact that it should be fairly easy to get in this trade and fairly easy to get out of this trade if I need to, given the fact that there's a lot of liquidity. And I'm going to go ahead and then buy my protection a little further down there. So I've kind of opened myself up to like 4,200 to the downside, but now I want to adjust my upside because I think there's less upside movement potential. I'm going to go to about maybe 43.20 here, and that's going to be my short strike, and then I'll do 43.30 call as my long strike. So what's kind of unusual about this right now? Well, this is what's called a skewed iron condor. This is not an equilateral iron condor where I have the same amount of risk on both sides. So why would I do this type of condor? Well, the reason I'm doing this type of condor is if we come back and take a look, we can see that our market has, it is in an uptrend. It has been moving up. And so I really want to take on a little less risk in the upside to this trade. But you'll also notice here's where we're trading right now. I'm leaving a little more downside space in this to allow it to move down into the 4,200 range. So let's take a look. Let's back this off to today because that was our model at expiration. Excuse me. So if I back this off to today, we're going to have some commissions and stuff to get into this trade. And so you're going to start off, pretty much at a zero line, about break even, somewhere in there on this trade. And then what I'm going to look to have happen is over a period of a few weeks, I'm looking for this trade to kind of do this in this general wide range of 42.20 all the way up to 43.20, maybe even a little bit higher. So I've got a very wide range that the market can kind of move in over the next 4, 5, 6 weeks up until July 6th or so. Around that time, I will be at, again, this is all modeling. There's no guarantees on this, but this is modeling that has been used, Black-Scholes, binomial models, etc., that have been used by traders for many, many, many years. In fact, I believe Black-Scholes got some sort of major award. I don't think it was a Pulitzer. I think it was a Nobel Prize, if I'm not mistaken, in economics for their work on that. But anyhow, my goal here is simply to let a little time decay on this thing, get this up to 10% profit range, somewhere in that general range. Once I get to around 10% profit, I may just pop it off and take my 10% in 3 weeks time frame, which obviously is a great return if you can rinse, wash, and repeat that. Or maybe I can make some adjustments to take some risk out of this trade at that point. And what we do is we tend to roll in our long strikes a little bit, and that can raise these two wings, this wing and this wing, so that we have reduced the risk on both sides, and we can still let this then decay in the middle. So those are the couple things that we're going to be looking at potentially doing with this trade as it progresses. So that's kind of how I tend to work and teach income trading. It's largely non-directional. Our goal with this trade, if we look at our Greeks here, is I certainly want theta, which is the decay that happens on a daily basis. So this is only a one lot of this trade, and it'll decay at about $3 a day or so. The closer it gets to expiration, the faster it will start to decay. Our delta is going to be largely neutral. We're not, delta is a measurement of whether we're bullish or bearish. Above a zero number means that you're going to be kind of bullish. A negative number here is going to be that you're kind of bearish. So we're largely going to keep this neutral, and by neutral I mean it's going to be somewhere between maybe a -2 or 3 delta to a +2, 3 delta, somewhere in that general range. Now, am I managing this specifically on the delta? Not really. But I just know in my head that's kind of what I'm looking for. I want to stay within this flat curve here is my goal or my objective as this thing decays over time. And then ultimately, again, at some point as we're decaying, maybe halfway through, maybe a little over halfway through, my goal is to go ahead and just close this trade out at or around 10%. So for right now, let's just go ahead. I want to save this trade. Again, this is a paper trade. I'm going to call this, let's see, I'll put this start to finish, and today's date is 6/7/23. And again, we won't do anything with this trade most likely if the market just kind of stays and chops back and forth for the next 2, 3, 4 weeks. Not even going to touch this trade, just going to let it decay. If we get a big move one direction or the other, we may need to look at adjusting this. And options trading, that's where the real art comes in, is learning how to adjust when something doesn't play out as planned. And again, I would say that of the trades that my students and I put on, probably 60–70% of them we don't end up needing to adjust, and probably 30% of them, they're going to require an adjustment during their life, and sometimes you end up with losers no matter what you do. But again, we're going to play this thing through start to finish. This is a paper trade. Want to stress that again. And this is where we're going to start. So let me go ahead, save this trade, and I will copy the link and paste it in down below as well in the comments section so that everybody can take a look at that. And this is, let me just scale this back here to where we're at now. So there we are at the start of our trade, and we'll just see how this progresses from there. So that's it on a skewed iron Condor. We're trading July 21st, and that is the setup of the Condor. So I will update this future sessions when it needs an update. I'll be dedicating a session to the adjustment that might need to take place on this and what that adjustment will look like. So that's it for now. If you have any questions, of course, post them down below. And thanks for any favorable comments as well. I really like doing these. And again, OptionStrat's a fabulous platform to help people get dialed in and understand all these weird nuances of trading options. So take care, everyone.